Hello everyone and welcome back to the channel. I want you to take a moment and mark a date on your calendar. Circle it, highlight it, set a reminder on your phone. The date is Wednesday, July 2nd, 2025. Because according to information from several trusted, high-level sources, that is the day the floodgates open. That is the day a spot Solana Exchange Traded Fund, or ETF, doesn't just get approved, it gets launched on the New York Stock Exchange. But this isn't just another crypto ETF. This is something far more significant, a financial product so revolutionary it could fundamentally reshape the digital asset landscape and send the price of Solana to heights that most people believe are impossible. We're talking about a Solana ETF with native staking yield built directly into the fund. This is the story of how it happened, why it's happening, and what it means for your portfolio. Before we dive into the intricate details, the backroom conversations, and the technical price targets, I need to be crystal clear. The following content is for informational and educational purposes only. It is a synthesis of market analysis, insider whispers, and forward-looking speculation. It is absolutely not financial advice. The cryptocurrency market is notoriously volatile, and you should always conduct your own extensive research and consult with a qualified financial advisor before making any investment decisions. Your capital is at risk. With that crucial disclaimer out of the way, let's get into why July 2nd, 2025 is a date you cannot afford to ignore. To understand the magnitude of this event, we have to rewind the clock a little. The journey began with the monumental approval of the spot Bitcoin ETFs in January 2024. That was Act 1. It was the moment that Wall Street officially acknowledged Bitcoin as a legitimate, investable asset class. Trillions of dollars in institutional capital, previously sitting on the sidelines, now had a safe, regulated, and familiar bridge into the world of digital gold. The inflows were staggering, and the price action that followed spoke for itself. Bitcoin shattered its previous all-time highs, not because of retail frenzy, but because of a systematic, sustained flow of capital from the world's largest financial players. Then came Act 2, the spot Ethereum ETF. This was a much more contentious battle. The SEC, led by Gary Gensler, was hesitant. They wrestled with the question of whether Ethereum was a security, and they were particularly concerned about the concept of staking. The initial sentiment was overwhelmingly bearish. The market expected a flat-out rejection. But then something shifted. The political winds in Washington changed. There was a sudden, unexpected pivot, and against all odds the Ethereum ETFs were approved. However, they came with a compromise. To get the product over the finish line, the issuers, like BlackRock and Fidelity, had to remove the staking component from this -1 filings. This meant the Ethereum ETFs would hold ETH, but they wouldn't participate in network validation to earn staking rewards. It was a huge win for legitimacy, but it left a critical feature on the table. This is where our story, Act 3, begins. The approval of the ETH ETF without staking wasn't an endpoint, it was a strategic move. It set a precedent. The SEC had now, implicitly, classified both Bitcoin and Ethereum as commodities, or at least, not securities in a way that would preclude an ETF. The market began to ask the logical next question, who's next? For months, the debate raged. Was it XRP, with its legal clarity following the Ripple lawsuit? Was it another Layer 1, like Avalanche or Cardano? But behind the scenes, the groundwork was already being laid for the true heir apparent, Solana. Why Solana? From an institutional perspective, the reasoning is threefold: technology, ecosystem, and narrative. For us, the technology. While Bitcoin is digital gold and Ethereum is the decentralized world computer, Solana is high-frequency finance on the blockchain. Its unique proof of history consensus mechanism allows for theoretical speeds of up to 65,000 transactions per second, a fraction of a cent per transaction. The network outages that plagued its early days have been systematically addressed with updates like Fidencer, developed by Jump Crypto, which has dramatically improved network stability and performance. For institutions that care about speed, throughput, and scalability, Solana presents a technological marvel that looks and feels much closer to the traditional financial rails of Nasdaq or the NYSE than anything else in the crypto space. It's built for the very scale that Wall Street demands. Second, the ecosystem. An asset is only as valuable as what you can do with it. And Solana's ecosystem is arguably the most vibrant and rapidly growing in all of crypto. It's not just about DeFi protocols like Jupiter, Marinade Finance, and Jito, which are pushing the boundaries of decentralized exchange and liquid staking. It's about real-world use cases. It's the home of the PIN, or Decentralized Physical Infrastructure Networks, with massive projects like Helium, the decentralized wireless network, and Render, the decentralized GPU rendering network, migrating to Solana for its speed and low cost. It's become the undisputed king of consumer-facing applications, from the NFT boom led by projects like Mad Lads to the explosion of meme coins like Bonk and Dog with Hat, which, whether you like them or not, have onboarded millions of new users to the blockchain. This diverse and thriving ecosystem demonstrates product-market fit on a scale that few other chains can claim. Third, and perhaps most importantly, the narrative. Wall Street loves a good story. Bitcoin is the inflation hedge. Ethereum is programmable money. Solana's narrative is that of the comeback kid, the Ethereum killer that actually survived the crypto winter and emerged stronger, faster, and more resilient. It's the story of a platform that can handle Visa-level transaction volume, making it the perfect candidate for the tokenization of real-world assets, a multi-trillion-dollar industry that firms like BlackRock's Larry Fink have repeatedly said is the future of finance. So, with this powerful trifecta of technology, ecosystem, and narrative, the giants of finance, spearheaded by BlackRock, began their quiet lobbying efforts with the SEC in late 2024. But they learned from the Ethereum ETF battle. They knew that a direct assault might fail. They needed a new angle, a Trojan horse. And that Trojan horse was staking. Here's where it gets truly fascinating. The sources we've spoken to indicate that the argument presented to the SEC was not about proving another crypto asset. It was about proving a new type of yield-bearing instrument, something that traditional finance could understand. Think of it like this: a stock can pay a dividend. A bond pays a coupon or yield. In the world of crypto, a proof-of-stake asset like Solana can be staked to earn rewards for helping to secure the network. The argument put forth was that to deny investors a staking yield from an asset like Solana would be akin to an ETF holding dividend stocks but refusing to distribute the dividends to its shareholders. It would be a disservice to the investor and an incomplete representation of the asset's value. This reframing was genius. It shifted the conversation from the speculative nature of a cryptocurrency to the familiar, established concept of yield. Furthermore, the technology for institutional-grade liquid staking had matured significantly. Companies like Figment and Anchor, along with protocols native to Solana like Jita and Marinade Finance, had built robust infrastructure that could allow a massive entity like BlackRock to stake billions of dollars worth of SOL securely and efficiently without taking custody of the private keys themselves. They could delegate the stake to a diverse set of validators, enhancing network decentralization, and seamlessly pass the resulting yield minus a small management fee directly to the ETF shareholders. The SEC, having already crossed the Rubicon with the Bitcoin and Ethereum ETFs, and facing a more crypto-friendly political environment post-Minus 2024 election, was far more receptive to this argument. The approval process, which began in earnest in the first quarter of 2025, was remarkably smooth compared to its predecessors. It was handled less like a controversial crypto product and more like an exotic fixed-income instrument. The decision was made quietly and internally sometime in the late spring of 2025. The launch date was strategically set for just after the second quarter of the year ended, at a time when institutions are ready to deploy fresh capital. Wednesday, July 2, 2025 was chosen. Now, let's summarize the current market sentiment as we hypothetically approach this date. The sentiment can be broken down into three camps: the bullish, the bearish, and the neutral. The bullish sentiment, which I believe is the most probable, is bordering on euphoric. The bulls see this not as an incremental step, but as a paradigm shift. The approval of a Solana ETF with staking is the ultimate validation. It establishes a crypto trinity in the eyes of Wall Street: Bitcoin as the store of value, Ethereum as a decentralized settlement layer, and Solana as the high-performance application and yield-bearing layer. The key differentiator is the yield. A spot Bitcoin ETF is a non-productive asset. Its value is purely based on supply and demand. A spot Ethereum ETF without staking is also non-productive. But a spot Solana ETF with staking is a productive asset. It generates cash flow, or more accurately, token flow. Imagine you are a portfolio manager at a pension fund. You have a mandate to generate a certain percentage of return each year. You can buy a treasury bond for a 4% yield, or you can buy the iShares Solana Trust, or whatever it will be called, that holds SOL and, after fees, pays you 5 or 6% yield in the form of additional shares. Plus, you get the potential price appreciation of the underlying asset SOL. This makes the Solana ETF an infinitely more attractive product to a massive swath of the financial world that is desperate for yield in a complex macroeconomic environment. The bullish case predicts that the inflows won't just be a river, they will be a tidal wave. Billions, then tens of billions of dollars will pour into this product, creating a massive supply shock as the ETF provider has to go out into the open market and buy up all available SOL to meet the demand. This sustained, programmatic buying pressure from the world's biggest asset managers is the fuel for an explosive price rally. The bearish sentiment, while a minority view, still exists. The bears point to a few potential risks. The first is regulatory rug pull. What if, at the last minute, the SEC reverses course or imposes some draconian restriction on the staking component? While our sources suggest this is highly unlikely, it's never a 0% chance in the world of crypto regulation. The second risk is a sell when news event. The argument here is that the anticipation of the ETF has already been priced into Solana over the last year. The price has run up significantly, and the moment the ETF launches, early investors will take profit, causing a sharp, albeit potentially temporary, correction. The third bearish point is macroeconomic. If we are in a deep global recession in mid-2025, even an event as bullish as Solana ETF might not be enough to overcome widespread risk-off sentiment in the broader markets. Money might flow into safe havens like bonds and the dollar, not into what is still considered a high-risk technology asset. Finally, there's the neutral sentiment. This camp believes the impact will be positive but more gradual. They agree the ETF is a big deal, but they think the initial inflows will be modest. They argue that it will take time for large, conservative institutions to get comfortable with the product and for it to be approved on all the major brokerage platforms. They see the ETF launch not as a rocket launch, but as the beginning of a long, slow, steady climb. The price of Solana will appreciate, but it will be a multi-year process, not a parabolic explosion in a matter of weeks. They expect a slow grind upwards, with the staking yield providing a solid floor under the price. Now, let's get to the part you've been waiting for. A technical analysis and a forward-looking statement on the price of Solana. Let's paint a picture of the chart leading up to July 2025. Over the course of late 2024 and early 2025, as whispers of this ETF began to circulate among sophisticated investors, Solana has been in a steady, powerful trend. Let's assume for our analysis that by June 2025, Solana has already reclaimed its previous all-time high of around $260 and has been consolidating in a range between $400 and $550 for several months. On the weekly chart, what we see is a textbook bullish consolidation pattern. It could be a massive ascending triangle with a horizontal resistance line at $550 and a series of higher lows forming the hypotenuse. Each time the price has approached $550, it has been met with selling pressure from those taking profits. But each time it has pulled back, the buyers have stepped in at a higher level than before: $350, then $400, then $450. This indicates that the selling pressure is being absorbed and the underlying demand is growing stronger. The volume profile for this period would show a massive amount of trading activity within this consolidation range, building a huge base of support. The key moving averages tell a similar story. The 50-week moving average would be sloping up aggressively, acting as dynamic support on any pullbacks, while the 200-week moving average is far below, indicating a powerful, long-term secular bull market. The Relative Strength Index, or RSI, on a weekly chart would have cooled off from overbought levels during the initial run-up and would be coiling in the 60-minute 70 range, signaling that there is plenty of room for another major leg up without being excessively frothy. This is the technical setup just before the launch. It's a powder keg waiting for a spark. The announcement and launch of the spot Solana ETF with staking on July 2nd, 2025 is the spark. So here is our forward-looking statement. On that Wednesday, as the ETF tickers, let's call them ISIL for iShares and SSOL for Fidelity, go live, we will witness a breakout of historic proportions. The $550 resistance level will not just be broken, it will be obliterated. The initial buying pressure from the ETF issuers, who need to acquire the seed capital of SOL, combined with a massive wave of FOMO fear of missing out from retail and professional traders who now have definitive confirmation, will ignite the rally. Our short-term price target, for the weeks immediately following the July 2nd launch, is the 1.618 Fibonacci extension level measured from the start of the entire 2024-2025 bull run to the peak of the consolidation phase. This is a standard technical target for a major breakout, and it points directly to a price of approximately $750 per SOL. We would expect to see this level hit before the end of July 2025. There will be volatility, of course. There will be sharp 10 to 15% pullbacks along the way as leverage is flushed out of the system, but the overwhelming trend will be upwards, driven by the relentless daily inflows into the ETF products. Now for the midterm target, looking out to the end of 2025 and early 2026. This is where the true power of the institutional inflows and the supply shock comes into play. Major wealth management platforms like Merrill Lynch and Morgan Stanley typically take a few months to conduct their due diligence before approving a new ETF for their advisors to recommend to clients. Once these platforms give the green light, usually 3 to 6 months post-launch, a second, even larger wave of capital is unlocked. This is the slow money, the trillions held in retirement accounts and managed portfolios. As this capital begins to systematically allocate even a tiny fraction, say 0.5% of their portfolios to the Solana ETF, the supply crisis will become acute. The amount of liquid available SOL on exchanges will dwindle rapidly. Remember, a significant portion of SOL is already locked up in staking and DeFi. The ETFs will effectively be taking another huge chunk out of circulation permanently. Its basic economics, dramatically increasing demand meets drastically shrinking supply. This is the formula for a parabolic price advance. Based on conservative models of ETF inflows, which factor in both the attractiveness of the staking yield and Solana's smaller market cap compared to Bitcoin and Ethereum, we project a price target of $1,200 per Solana by the end of 2025. This would give Solana a market capitalization of roughly $600 billion, still significantly less than Ethereum's peak market cap, making it an entirely plausible valuation given its enhanced utility and institutional adoption. Reaching this level would represent more than a doubling of the price from the pre-launch consolidation phase. It's a move that would create life-changing wealth for those positioned correctly beforehand. What about the long-term, blue sky scenario? If the tokenization of real-world assets truly takes hold on Solana, as predicted by industry leaders, and if the staking yield remains competitive, the $1,200 target could end up looking conservative. In a world where trillions of dollars in stocks, bonds, and real estate are represented as tokens on the Solana network, the demand for the native SOL token to pay for transaction fees and secure the network would be astronomical. In such a scenario, a price of over $2,000 per SOL within the next 5 to 7 years is not out of the realm of possibility. The implications of this event extend far beyond just the price of Solana. The approval of a staking-based ETF would be a landmark moment for the entire crypto industry. It would legitimize the concept of yield generation from digital assets in the eyes of global finance. It would pave the way for a whole suite of similar products. Imagine a Cardano ETF for staking, a Polkadot ETF of parachain rewards, an Avalanche ETF of subnet fees. It creates a new asset class, yield-bearing digital commodities. This could unlock a torrent of innovation and capital flow into the layer 1 protocols that are the backbone of the decentralized web. So, as we approach that pivotal date, Wednesday, July 2nd, 2025, the market will be holding its breath. The launch will be the lead story on every major financial news network. We will be watching the trading volume in those first few hours, the premium or discounted net asset value NAV, and the statements from the issuers. The first day inflow numbers will be scrutinized by everyone as they will set the tone for the weeks to come. A $1 billion first day would signal an incredibly aggressive uptick and would likely accelerate our price targets. In conclusion, the launch of a spot Solana ETF with included staking is not a matter of if, but when. And all signs are pointing to a coordinated launch in the summer of 2025. This event is the culmination of years of technological development, ecosystem growth, and strategic navigation of the complex regulatory environment. It represents the fusion of decentralized finance's most powerful feature yield with the unparalleled distribution and capital of traditional finance. It's a catalyst so powerful that it will likely ignite the next major leg up in a crypto bull market, with Solana leading the charge. The combination of its superior technology, vibrant ecosystem, compelling narrative, and the game-changing addition of a staking yield makes its ETF product a potential category killer. The technicals are aligned for a massive breakout, and the fundamental case, driven by an impending institutional-led supply shock, supports price targets that may seem outlandish today but will look obvious in hindsight. The road ahead will be volatile, but the destination appears increasingly clear. $1,000 Solana is no longer a dream, it's a very real, data-driven probability. The coming months will be a crucial time to pay attention, to do your own research, and to understand the seismic shift that is about to take place. The crypto world is about to be reshaped once again, and it all starts on one specific Wednesday. Thank you for joining me for this deep dive. I'd love to hear your thoughts on this thesis. Do you think the Solana ETF for staking is coming? What are your price targets? Let me know down in the comments below. And if you found this analysis valuable, please consider liking the video and subscribing to the channel for more in-depth content on the future of digital assets. Until next time, stay informed and invest wisely.